Hello and welcome to our Yardi Matrix Multifamily National Outlook on October 20th, 2021. My name is Megan Clay, your producer for today's program. We are joined today by our hosts Jeff Adler and Jack Kern. Our program will run about an hour and we hope you can stay with us for the entire broadcast. We want this to be an interactive conversation, so please feel free to submit questions in the Q&A icon at the bottom of your screen, and we will try to respond to your messages while covering relevant topics. If we don't get to you, please contact us afterward for a more detailed answer. A recording of this broadcast and accompanying slides will be available after the program. Please note that what we discuss today may or may not be relevant to our situation. Please read the disclaimer carefully and consult your tax and investment advisors before making any decisions. Now, I am pleased to welcome Jack Kern, Director of Research and Publications, and Jeff Adler, Vice President of Yardi Matrix, to our program today.
Thank you, Megan, and thank to all of you for spending some time with me today, and Jack and I. What I wanted to cover, just a quick agenda. We'll go through kind of opening remarks, what we kind of view as what's going on in the macroeconomic outlook, demographic trends, multifamily fundamentals, and a kind of combination of investment risk and work we've done over the past 2 years into one consolidated approach. And we'll also touch on the emerging single-family rental built-to-rent kind of subclass within multifamily. And so, as we normally do, I'll kind of go over kind of what I view as the answer, and just kind of to go back a few months. What we saw 6 months ago was we had a concern about emerging inflation, and we hope to see some kind of rectification of that in the next 6 months, right about now, or we would know whether it was temporary or permanent. Migration. And the movement of people and labor, we thought there was sort of this emergence of a movement of people and a shifting and reallocation of people, and we've really seen that happen over the last 6 months. We'll talk about that a little more. And then regulation, which is I see that as a steeper risk. We put that into the investment risk profile, and of course single family rentals, which we had just begin to understand and just begin to cover. We've done a lot more of that. So first of all, kind of where we come out on things. The economy is expanding. We are in an expansion. I'd say headwinds are growing. The reality is that disruptions, whether they are supply disruptions, supply chain disruptions, a labor market that's been disrupted, is creating inflation, which is, in our view, not transitory, is likely to be more permanent. And with the combination of a tremendous amount of cash and liquidity and demand, that is leading to inflation that we think will is something that everyone should factor into. Migration, the pandemic, and we've really seen this over the last 6 months. There's been a general spreading of the population across metropolitan areas and within metropolitan areas. And in my perspective of this is actually the American people basically solving a supply problem in the urban, most highly expensive areas by moving to places that they're able to take their paycheck with them to less expensive areas, improving their overall welfare. So this is real redeployment of people, and it is not over yet. Rent growth has been unbelievable over the past 6 months. We do think it will trail down, but it has absolutely been a barn burner. And when it comes to regulation, really, and I would say just the biggest issue one has to wrap their head around as it relates to migration, in my view, is you have to have a position on what return to the office does or does not look like. That fundamental decision, that viewpoint, will inform your investment strategy as to where you lean. And I think that's probably the most critical decision to wrap your head around and to have a firm-wide understanding and an argument about what that actually looks like. We do see a spreading of that population. I'll talk about market selection and political risk, infrastructure risk, and now we're also incorporating environmental risk. And I would say it is a framework as opposed to, when you see the scoring, it's not like the absolute answer, but I do think it is insightful, and we'll talk about that in a little bit. We'll also talk about our views on overall commercial real estate and other sectors. We'll touch on that at the end. So just to kind of cover where the economy is. The third quarter, is a lot stronger than it appears to be. The Atlanta GDP model is kind of broken down, and it's mostly due to these supply disruptions where there's a lot of demand, but whether it gets translated into actually recorded GDP is a function of these supply disruptions. So I would say that the economic growth is good, but it is being hampered by supply disruptions both in the material markets and in the labor markets. And if you look at sort of an economic forecast, we're clearly in a V kind of shape rebound. That's kind of an old argument that was occurring 6 or 7 months ago. And we look at I look at the 2022 forecast as the one that's most relevant. 4% inflation, I think, is very reasonable, but strong economic growth, 4.5% real GDP growth, and a movement in bond yields. We're already at 1.6. The forecast at the end of the year is 1.75. I think going to 2.5. And the market is beginning to handicap 1 or 2 Fed funds increases sometime in 2022 as the Federal Reserve finally begins to wrap their head around the fact that the transitory story isn't really kind of working. But I do think we really are in a continued expansion. And we look at the financial markets, what I take away from that is the yield curve is still positively sloped. That's a positive. The 10-year Treasury still has a lot of room to run and is absolutely in negative real rate territory. And with that, bond yields in the U.S. are still the highest in the developed world, which means we're still sucking in capital from other places. And while there's a bit of a choppiness over the last month or so in the stock market, in the S&P 500, I think we're actually set up for a pretty good fourth quarter there as well, with earnings and equity values actually continuing to grow. There will be some headwinds and choppiness, but I don't think it's a big deal. I think one of the bigger topics we kind of wrap your head around is, though, that inflation. It's rippling through the economy and it's not over. If you look at the kind of the long run prior to the pandemic, services inflation was always running around 3 to 4%. It was offset by goods deflation. And now that hasn't happened. So we still have services inflation, and you could say in part of opening the economy, there's fits and starts to that. But you really start having goods inflation. The Fed's story has been that inflation is transitory, but believe me, it's not looking that way to me or to us as an organization. Commodity prices are surging. Rent growth hasn't even made its way into the official CPI and inflation indices. There's labor shortages all over the place, particularly at the lowest end of the economic scale. We've seen some strikes, which we haven't seen in, 20, 30 years. There is a lot of dry powder in terms of consumer spending, of the liquidity that was created by the Fed. That's the sort of classic Friedman, too much money facing too few goods. And there's been a large movement of people because they've been able to do that with the emergence of, initially it was pandemic induced, and now it's sort of something beyond that in terms of where people live related to where they work. So let's take another little bit of a look at that. If you look at this is just a graphic that just says how much liquidity has actually been thrown at by the government printing of money to keep consumption stable. And what this tells us is a lot of that has pushed its way into savings, which has not yet been deployed into a demand for goods. It is beginning to be deployed into a demand for goods. And so that's why we see while industrial production is about level, pre-pandemic levels, demand is up about 14%. So you have this sort of dislocation between liquidity, dollars, and the goods available to buy them. And that's what's a lot of driving up. And if you go back to Ray Dalio, some of his insightful work on big debt crises, you will see that every big debt crisis usually is related to an expansion in the money supply and some disruption to the productive capacity of a society. And we certainly fit that description at the moment. Now, when you look at sort of the inflation over some number of periods of time, you can see that education, healthcare was really driving, so that's the services inflation, was really driving inflation and was offset by goods deflation. And we've seen here in this last couple of months, just the opposite, right? Services inflation down, goods inflation up. I do think we will see a recovery in services inflation. And we're also seeing a expansion of goods inflation. And we really haven't even seen the rent, as I mentioned before, the rent impact flow its way through the inflation metrics. And this is just a notion of the extent to which consumption is up in goods and services, and really, kind of powering away. That has implications for obviously industrial, because retail sales are up a lot across all channels with a particular focus on e-commerce. And then if you look at that non-store piece, that's really the e-commerce side, as well as all these other kind of categories. There's a lot of just consumption, still sporting goods, furniture, building materials. Now there has been a rotation, and I would say to services, right? So consumer spending on services has picked up, and we expect it will continue to pick up. Third quarter will be choppy with the Delta variant data kind of muddying the waters a little bit. But there clearly is if you go across all of there's shortages of cars in the car rentals because capacity was reduced. Hotels are sort of starting up mostly on the discretionary side, much less so on business travel. And restaurants are open, but again, feeling all kinds of disruptions on labor and material costs and rising restaurant prices. Now, if you look at just the data itself, right, on the inflation data itself, you'd say, well, what's the big problem? Maybe the Fed is right. Maybe it's just all kind of sensitive items that's related to opening, and everything will be kind of copacetic. I disagree with that perspective, primarily because of all the other disruptions we've seen in the economy and in supply bottlenecks, as well as rising wages. And this is the beginning of a potential, once you get a kind of a wage price spiral and a kind of a inflation feedback loop with food and energy, and no countervailing reductions in pricing or competitive pressures, you begin to get a inflationary liftoff. Now, for those of us who are under 55, you probably have no idea what an inflationary spiral looks like. You'd have to go back and read your history books. But I think a reading course in history books probably would do you quite well to be very cautious about the signs we're seeing here. Now, oil prices are up. They're in the 70s and 80s. We are seeing, some supply response in the U.S. Drilling count actually is moving up slightly, but there's been lots of disruption, and the energy policy of the administration really requires an oil price of around this level. And what we're also seeing is a translation of this cash flow not into additional production domestically, but into pay down of debt and financial position of the drillers. So without some competitive impulse to drive oil production up and prices down, this is probably where we are into oil prices. I'm going to cut to you, Jack. You know a lot about the oil industry, just to get your perspective on just what's going on in the petroleum industry.
Oddly enough, the petroleum industry is still seeing a great deal of strength in rig counts, not so much on the shale side of it. The prices seem to be kind of moderating a little bit, but they're hitting somewhere between 80 and 90, which is higher than what they typically would be looking for, which is close to $62. And we think that long-term oil prices are probably going to continue staying somewhere between 75 and 85.
At which point, so there's basically, well, we may not be increasing, it's going to provide a cost burden on purchasing power. And we're also beginning to see, as been noted, increases in natural gas pricing. So the other part of this is, and I love the diagram here, is rent. If you look at the very tail end of that, the spike in rents relative to CPI. And just in this particular downturn, the housing industry is actually benefiting, right? And so the last GFC housing, both for sale and rent, kind of went through a period of a meaningful downturn due to oversupply and other financial constraints, and that has absolutely not been the case this go round. Now, when we look at unemployment and underemployment, it's coming down. It continues to move, but what's not exactly being captured is the decline in the labor participation rate, which is we have this unbelievable number of job openings, and yet we still have a 5% unemployment rate. And if you look at that, you see the openings rate, right? There's 10 million openings, and the labor participation rate has taken a bit of a drop. 1.5 points is kind of meaningful, and it does not look as if it is pulling out. And everything that we've seen maybe from the last expansion was it takes an extended period of time of positive job formation and demand to pull people off the sidelines. And when you look at that kind of a little bit deeper, labor force participation rate by age and gender, one of the biggest drop-offs has been 55 plus. Now, with the demographics of our society being what it is, we're not getting a lot of immigrant labor. We had really depended upon the 55 plus to stay working longer so that we wouldn't see this kind of labor shortage. That is not happening. It's not so much a male and female issue as much as it is an age issue. That's what kind of what we're seeing most of all. In fact, but female participation rate has gone down some, and most recently has not been recovering. And there is an effect of a survey I just saw that Indeed kind of got off the web, was that if you look at why people aren't returning, the top 3 or 4 reasons were they have a spouse that's working, they've built up enough of a savings, and yes, there are some care issues that they have to deal with. Unemployment insurance being less of a factor now. So this will take some time to burn off. And there's a lot of resorting in the labor market. And this is a problem because of the shortages of labor we're seeing across the economy. And if you look at this by education level, furthermore, right, you see that a high school graduate has taken the biggest hit and is not really coming back yet. So these are kind of significant issues. And when you also look at by industry, right, you also see hotels, restaurants, and childcare industries. And these are support industries that enable other economic activity to occur. So I would say, just as you look at supply bottlenecks and creating pressures and supply pressures and pricing concerns on the supply side, this is, if you look at the supply of labor, you also see these same disruptions, these same pressures, which will, in my view, continue to add to wage inflation pressures. And you can see that here in terms of the hourly earnings changes, leisure and hospitality, transportation, warehousing, not so much like in the, I would say yet, right, in the office using employment sectors, the tech industry and so forth, or those service industries, but at the bottom end. Now, there are shortages on the tech side, particularly in programming labor, which are also driving costs up, but those were there prior to the pandemic. Now, if you look at that, and we'll take a quick kind of gut check here, right? What you see is an economy, it's got a lot of liquidity, it's got a lot of available demand. It's trying to translate that demand into consumption, and it's struggling, and it's creating all kinds of bottlenecks, pressures, price pressures. It's also providing pricing power to a lot of companies to be able that they actually can execute on price increases, and there is not a lot of countervailing. The impacts we have of aging, the demographic, and technology, which have been deflationary, the impact of trade, which had been deflationary, the impact of oil and energy prices, which have been deflationary. These deflationary factors are not yet in full evidence, and the supply disruptions are taking full core. So one should expect coming out of this a whole series of supply disruptions and pricing power and inflation, and which in the short term will inure to the benefit of commercial real estate, but bears risks of a potential Fed overreaction and slowing the economy down. But I don't think we're likely to see that for about 3 years or so. Now, let me shift for a moment to demographics before we kind of move on to the actual fundamentals. And here, this isn't necessarily new information, but it bears kind of repeating that the biggest cohort as the population ages is 65 plus, which had not really been a renting cohort in the prior, but they're living longer and healthier. So it's, if you see, and then you look at the 25 to 44, that's growing a little bit, offset by 45 to 64 going down. So now the question in my mind is not so much the number of people, which isn't growing as rapidly, and we'll see that in terms of a declining birth rate and significantly declining population growth, but the geographic disposition of that demand, particularly the sort of the older half of that 25 to 44, which are entering into child rearing and need extra space in that situation. Now, if you look at median age at first marriage, continuing to decline, average mother's age at first birth increasing, average birth rate for major cohorts declining, you see that there's as I've mentioned before, a stretching out of how long people are in the traditional multifamily period of time, and a movement. If you look at this, the fertility rate, it has taken another leg down here. If you look at from 2013 to 2020, it had been kind of level in the 90s. It's taken a leg down. And I think that is a driver of the fact that a population growth, our death rates for the first year probably went up a little bit, but normally it wouldn't have gone. Death rates being a long run stable, birth rates declining, and very little immigration means the significant decline in the population overall in the United States. If you look at this in terms of population by age, right, you'd say, oh, okay, We have a declining number of people who are going to be coming into the rental age, and an increasing number of people who would normally be buying a home. But again, the age at which things are being done are being stretched out. So the renter population is being more evenly spread out across that from a national level, but the real action is the geographic level. And if you look here in terms of household formation and completions, I do expect in 2021 to be a significant increase in household formations. While it looks as if we're beginning to ramp up supply, that accumulated deficit coming out of the GFC means that we have a shortage of supply of housing in the places that people want to live. And we're seeing it obviously in home prices and in rental prices. Right? And if you look at this in terms of home prices, yes, this is influenced by a decline in interest rates for home prices, but layered on top of that has been a shift in where people live and a movement to lower cost locations. And I would say overall an improvement in consumer welfare because of that. But the increases, if you happen to be living in one of the inbound markets, has been rather dramatic. I'm going to shift now to sort of looking at our sort of investment strategy portfolio. We've kind of taken a look at three kind of markets: global gateway markets, established tech hubs, and emerging tech hubs. Now, we cover a lot more markets than this, but these are just a good mixture of markets to take a look at when we think about investment strategy. So, affordability concerns were very apparent, which led to the movement out of expensive gateway cities, right? So the pandemic and the response of office using service work, really, rather than being put into a production environment in an office. I think the biggest impact has been process-driven work, right? And so folks who are involved in process or creative have moved out. I think there will be a reformation, and we're seeing that already in terms of transaction-driven work, which those teams will be together. But if you take a look at an example of Austin, right? Austin, it was a city that always built too much. There was always more supply than demand, and it was very hard to get rent growth. It took a massive migration of people out of San Francisco into Austin, and it happened around March and April for rent growth to finally happen in Austin. And it is now on a tear, both on a sequential basis and a year-over-year basis. And you can see this here in the fundamentals of Austin, and you really just did not see any kind of increase in rents or occupancies. It means that the supply was always ahead of demand, and just demand finally caught up, and we see that a lot in some of these markets. So in terms of markets already seeing a surge in migration, right? We already have seen a movement of people from a domestic migration, and that's really where the action is happening here. Is a movement of domestic migration across metropolitan areas and within metropolitan areas. And because the metropolitan areas where people are leaving are so huge, it does not take a huge impact when they're moving to a smaller metropolitan area with less population to have a meaningful impact on that rental market. And that's exactly what we've seen. You can also look at this in terms of change in net moves per 1,000 population. And that gives you a view of the impact of that change. Between population centers. And so I think one of the bigger, as I've kind of alluded to before, one of the bigger issues is work from anywhere, okay? And it's not necessarily as much of somewhere you go, but something you do. And now we're seeing this, fraying, right? Like what functions are actually what companies, what industries, what companies, and what functions within a company are optimally needed to be located in an office environment, okay? And so, there are some industries that and functions that require in-person interaction, very early stage VC work, as well as financial deal teams and legal teams, was what we've seen. But a lot of the work was process-oriented and repetitive, or execution of a process. And that's where the knowledge of, do I need people to be in an office, is frayed, okay? And that's kind of one of the bigger topics that we're seeing kind of played out here. And it is very much being played out by industry. So the financial services sector, because of security issues and deal teams, looks to be one of the more office space, and I would put legal in here as well. Deal teams and those kind of things. But government, kind of a hybrid. A lot of the background work can still be done in a remote environment. The in-person work is being much more structured, and there is a movement to automation and self-service, but there's still some in-person work. Technology is more hybrid to fully remote. That is both, again, there may be elements of early stage companies that need to be sort of in person in order to sort of get their business running. But a lot of the technology companies are large process driven organizations where most of the employees are not necessarily kind of innovating. And even those that do innovate, a lot of the work can be done remotely. And education is more of a hybrid in person, depending upon certainly K through 12 education needs to be in person, but college is becoming more of a hybrid model where the high end will be in person, but there will be a hybrid component. So we've looked at this before, but just to kind of recap, we do think that 35% or so of the workers will return full-time 5 days a week, no question. But the remote will go from 5 to 10 to 20 to 25. And that's a big chunk at the margin. And then the rest are some kind of hybrid. And what hybrid looks like, as you all know in your own companies, is probably still being all fleshed out and what that actually means. Now, what we've taken a look at this and says the impact could be big. I don't think is as big as here we note, but what it means is there is a lot of things still in play. And I don't think that is over yet. I think this process has got a couple years to run in terms of how it all sorts out. A lot of companies aren't really sure. They're trying to figure it out in terms of what needs to be done where, in what way. And so I do think there is a return to the office in some way. We see some of the Castle data there. A lot still being played out. And your company should have a viewpoint. We have a viewpoint that it's a thing. It's not going to go back to the way it was, but neither are office is going to be irrelevant. But over time, I do think that there is a shrinking of footprints and there's a consolidation into the best locations. And so there is a problem for Class B or a Class A minus office that space may need to be converted into other uses. And that is going to be a slow rolling problem because of the nature of the long-term leases. Now let's kind of shift to fundamentals. So first thing, this is probably the biggest thing that if you're in the industry, you've experienced is, holy moly, March was like turning on a faucet. National rents suddenly popped and they popped big. And this is just monthly changes, right? This is the monthly change, not on a year-over-year basis, but it shows you the movement that's happened in this traditional leasing season. It's been incredible. It's just beginning to sort of slow, and I do think it'll moderate in the fall. If you look at this, and it kind of shocked me to actually put the line on average rent growth at 10% year to date. Normally that number would be like 3, show you the strength of it and also the absorption of stock. But you can see some markets having incredible absorption of stock as well as significant rent growth. And those that really didn't are quite few in number in terms of slower rent growth or slower absorption. San Francisco being a notable kind of outlier in this case, so it's the Twin Cities. But most markets have done extraordinarily well in terms of both rent growth and absorption. And if you look at this in terms of just occupancy change and rent growth change, again, look at the box to the upper right, and you will just see amazing increases. But even the ones that are sort of at the lower left, right, is still positive. Occupancy changes haven't been that much, but you still have rent growth over 5% in just about all markets. So there really has been an amazing sort of experience, over the past year of housing and fundamentals in multifamily really kind of taking off. Yes.
On this, go back one slide if you would,
sure.
Please. If you take a look at this quickly, what's your expectation in terms of transaction activity and likely shifting in compression or not in cap rates?
On this slide here, because we'll get to the sales volume in a second, but if you look at that, we're already seeing a significant compression in cap rates. Kind of sub 4 is the norm as opposed to the exception. There's not a lot of variance. There had been a variance between different cities. There had been a lot of variance with different asset types. So there's been a tremendous amount of compression on all of those because there's a tremendous amount of capital flowing out of office, which would have been deployed in office assets that are trying to find a home in both multifamily and industrial. So there's a lot of demand for assets, and depending upon how you're underwriting these recent increases, you can talk your way into some meaningful valuation increases. And so there's just a lot that's in flux. But certainly values, and I think we had alluded to this about a year ago, where we thought that there wouldn't be much decline in the values of gateway city assets, but a significant 20% increase in tech hub assets, and that's exactly what we've seen, if not more. And so what I would, if you look at the nature of each one of the recoveries of these markets, the tech hubs have just got a lot of tailwind. Now, I think it gets moderated as their price increases relative to the sort of the gateway city benchmark. There still has to be a value creation opportunity or an arbitrage between those cities. And if the amount of the spread of the rents gets squeezed, then that will reduce the arbitrage. Does that make sense, Jack?
Great.
Okay, super. So
Hey,
if we
Jeff,
just kind of, yes.
if you don't mind, before we shift from the rent conversation, we have a couple specific questions related to rents.
Okay, sure.
Rents have been soaring for the past 6 months, but it seems like none of that is included in the inflation data. Why is that?
It is a lagging indicator. So one of there's different measures of inflation. That the normal CPI, about 40% of that is what's viewed as owner's equivalent rent. And so that is a lagging indicator of rent increases, and it tends to take a while to flow through. Even the personal consumption expenditure, which is I think 25% of that index is rent. It takes a while for the changes that we've seen over the past 6 months to work their way into the official indices. And this is what I'm saying is inflation is far worse than the official metric. It takes usually some number of months, could be up to another 6 months for this impact flow its way through into the official numbers. It will eventually, but we're as an industry at the leading edge of a distribution of prices. There's always a distribution of increases and decreases. Rental housing, both single family and multifamily, is at the other end of that this time around. And it was at the left hand of the curve of the GFC, and now we're kind of at the right hand of the curve. If I got this right hand of the curve on this go round. So it just hasn't flowed. It hasn't made its way through to the metrics, which is why I think inflation is going to be worse than the official organizations understand it to be. And I've read some papers by different Federal Reserve regional banks. They don't quite seem to catch this. It's going to catch, but most of the private market economists are seeing it, and that's what's underlying their estimates and assumptions. Any other questions, Megan?
Yeah, I'll ask one more and then we can move on. With
Sure.
home prices and rent growth surging, the affordability gap is a real phenomenon. Do you expect this to hold in the future? And if so, why?
So the biggest dynamic you have to kind of wrap your head around is that if you look at this increase in rents, and it has astounding, right? You say, oh my God, how do people afford this? Well, if enough people at the sort of margin of the market are coming from very expensive locations with high average earnings, and they're able to bring those earnings into this new market, they can pay what's necessary, right? So supply response hasn't yet kicked in. There's a sudden surge in demand, and the people who are creating that surge in demand at the margin, for them it's a bargain. So if they pay 10 or 15% more than what was the prevailing rent before, it's still much less than what they had paid previously. They're better off. So they can pay it, and it goes on as long as that movement of population continues, right? If you're a resident in that sort of destination location and your wages don't adjust, right? And remember, it will take a time for these are new rent changes. So they haven't really worked their way through into the renewals yet. And the renewal increases are probably more like 8 to 9%. They won't be 20%. Okay, so the other thing to understand. But as this works its way through, yes, those people will be impacted because their wages haven't gone up 20%. And so they'll have a choice. They'll either have to move further out in the metropolitan area, which they can, many of them, at the margin, because they don't have to be in the office as much. so they can afford a longer commute. And so this spreading of the population. People will sort of maintain or increase their net welfare because they can move and because they're not necessarily tethered to an office location, at least not as much as they used to be. Right, they can make this work. Now, for those in the world who are hoping for densification and a reduced sort of environmental footprint, this is like a poke in the eye, because this is actually a greater level of suburbanization than a lot of folks. I was at ULI last week. We're all kind of freaking out about. The fact of the matter is, the market is saying a spreading of the population improves overall consumer welfare. And densification, because densification has not also been accompanied with a sufficient increase in supply in dense areas, or enough of them, you're leading to this sort of expansion of locations. Any other, is that I hope we're responsive?
Yes, thank you very much.
Okay, cool. Let's kind of continue. Multifamily sales volume, as a result of all these fundamentals, right? As a result of capital flows, as a result of fundamentals, as a result also of real negative interest rates, volume is back to where it was in 2019. There is a very, and we noted this, even 6 months ago, there's a very strong transaction market. There's a lot of capital getting deployed. There are a lot of deals coming to market where people are going to try to post some very good returns to their investors. And so we expect transaction volumes to be at very high levels for the remainder of this year and, quite frankly, into next year. Sales prices are beginning to sort of move in that direction, and we're beginning to see that kind of happen, and I expect that to become further amplified. When we shift to supply, and this is another piece of this, which is the supply that was in the ground and supply that was even planned was based upon previous demand characteristics, both within a geography and across geographies. And it is taking a little bit of time for the supply response to gear up. And so we are seeing, so Huntsville was a market we've highlighted before. It's beginning to sort of get some supply going, right? Miami, Austin, these other markets. Austin's got a lot of supply coming. Northern New Jersey, Nashville. So you have markets where there's a lot of supply under construction. There's also a lot of supply that is planned to come in. So the supply response is beginning to happen. There are some places perhaps where, let's say San Francisco, it might be a little bit of a problem, and some of these prospective deals may indeed get shelved depending upon how the fundamentals roll. And there are supply disruptions that are happening. But when we kind of go to take that entire pipeline and then forecast it out in terms of what we expect supply to actually happen, and the way this chart works is the length of the bar is the absolute number of units forecasted to be delivered each year, and the number is the percent of stock, right? So Dallas, while it's a big number, is about 3% of stock a year, and that is absorbable. Some places that there might be some concern is Austin, 6% of stock a year, as well as Miami, 6% of stock a year. That's a lot to absorb. Same thing with Charlotte and Orlando, for about 5%. So there are some pipelines that are pretty darn stout. Salt Lake City at 5%, where, again, if you give a couple out years, you're likely to see some supply pressure begin to build in the outer years. We've increased our supply forecast to about 400,000 units a year, up from about 350-ish. And I haven't even really accounted for the single family rental build to rent, which has the capacity and the capital to deliver about another 40,000 units a year, based upon the $30 billion that's been committed to it. So we do expect there to be some supply pressure brewing in the outer years. You can look at Boise at 7% of stock, right? Not a lot of numbers, but a lot of stock. So there will be some supply pressures in the outer years of this. But for now, we certainly have a good run for the next several years. And when we take a look at this in terms of historic absorption and historic completions, it kind of gives you which markets we kind of think are generally kind of in balance or necessarily not in balance. And I think in some of the markets, that we kind of look at this and say, well, will Portland or Denver absorb as much? I feel pretty good about the overall view here, in that most markets will remain in balance, but you could find a couple that do get out of their skis in the outer years. But when we look now at what in terms of rent growth and occupancy growth, and some of these like year-end numbers for rent growth, like blow me up. I've never seen this in my career, these kind of numbers in 2021. But we do after this kind of shock that's already happened, expect them to come down to, at least from a rent growth perspective, to sort of more normal-ish numbers, but still, historically speaking, if you look at the historic average of 2.8% rent growth over a 15, 20-year period of time, 5, 6, 7% is, even 4% is really good. And so that really undergirds and this is certainly after a 20% increase, or in many markets. So you still have high rent levels that are accelerating, and these fundamentals kind of undergird the valuation thesis of multifamily, and we're still going to be in a resorting of populations, both within metros and across metros, as this nature of work, right, kind of plays itself out. And with supply pressures building in the outer years, and a recession risk, again, I think building in maybe 36 months, but not for the next several years. When we look at actual kind of performance metrics, the gateway markets have begun to recover. They're at a slower pace in downturns, but by and large, with the exception, I think, of downtown San Francisco and West LA, everywhere has at least recovered its pre-pandemic level. And we've seen a recent surge in downtown DC and in Boston, and in some of the other markets that have kind of come back. And Manhattan has seen a recent surge, and downtown Chicago has seen a recent surge. But if you look at underneath that, and looking and talking to a number of my colleagues around the industry, the urban cores are being repopulated by younger people coming for the life experience, less so necessarily tied to the work experience in that city, but for the life experience. And so new lease transactions have an average age of 10 years younger than they did a year ago. And while rents are kind of coming back, they might be split by more people living in the same place and sharing the cost. So, and then when we look at the tech hubs, I mean, just crazy numbers, right? Like you look at this sort of spike, you can see in September the deceleration setting in most of these markets, but still rent growth of a meaningful level, and occupancy, kind of settling in as we would expect, prices rising to take advantage of occupancy. And if you look here on the urban cores, yes, there's definitely a recovery. We talked about it 6 months ago. We've clearly seen it in the data over the last 6 months. As we've kind of mentioned before, suburbs continue to outperform their urban counterparts in most of the markets. And it's just a question of the extent of the increase. But again, we talked about this. This is another indication of the spreading of the population within and across metropolitan areas, and supply still going into largely urban areas. I do expect this to shift as new projects come in, to have more suburban mix in the new supply pipeline. Now, one of the, as we shift to that, we kind of cover the basic metrics here. One of the things that we've really tried to focus in on is we've done separate analyses of political risk and infrastructure and environmental risk, and they've been published in different publications, AFIRE and other things across the last several years. And so one of the things we wanted to do was actually bring this all together. And I do want to mention that it is a framework, right? Because we've put some values and we've weighted it in a certain way. I think it really does require, and for our clients, there's an interactive workbook available where they can take a look at the data, the work we've done, and look at that and form and adjust their views as in terms of weightings within and across various classifications, as well as you'll see here a big one, which is the demand supply balance and how one thinks about that. Now, this is, I call it the simplest perspective, where we have 4 areas. We equally weight them. We equally weight the subcomponents, and it's a very simplistic perspective. And one thing I do want to kind of harp on is in that very first column, historical supply demand balance. And the way we're running this particular metric is too much supply is risk, too little supply is risk, right? So it's a question of, is it imbalance? That's where one would score the highest. And each one of us could have a different perspective to say, well, if there's a reduced supply, that's actually a good thing. Why would I rate it as a negative? And that, again, if you look at the workbook and get inside of it, that's where some of your adjustments would form. But what I took away from just this view of things is no market is great on everything. there, each market has its own pluses and minuses, and it really requires at least an understanding of the risk and exposure. So this one is sorted just by score. This one is sorted by population, the size of the market. And so depending on your liquidity requirements, we then did this is just a simple, another scenario where I took a look at this and said, well, what if I weight political and environmental risk at 10% and the other ones each at 40? Does that change things up? And it does change a few things up here. This is kind of by score, but you kind of look at it and say, well, wait a minute, Houston and Tulsa and San Diego and even Dallas seem quite high. Well, it's based upon the weighting and this notion of the different sectors. So I think what we're trying to draw out here is that if you're looking at risks, a fundamental risk, an infrastructure risk, a political risk, an environmental risk, it really requires a delving into this and picking apart the pieces and having a point of view as to, do you share our perspective on what's high or low risk, and how do you weight them? And how do you weight them internally within those groupings? So again, I would say this is more of a framework, but we wanted to at least have it a holistic framework all in one place. And this is by population growth. I find this very insightful, and we actually, for example, in the environmental risk in Dallas, in terms of natural disasters and environment, and the natural disaster risk is also electricity burden, was actually prescient when this was done. When I went back and looked at the February, we had this done earlier, and then we actually looked at it and said, oh gosh, I guess Dallas did have a little more exposure than we would have thought. And so this actually is an interesting way of thinking about this view. And all that you'll see at the back of this presentation, we will have a fairly large appendix to explain our thinking. I don't have enough time to go through this here. And for clients, we'll actually provide the workbook upon request so they can begin to bite into this. Okay. Now, and this is just a notion of some of the risk factors we've identified and ranked, and kind of what's behind it. So we've gotten a lot of requests from clients, both on the environmental risk side as well as international clients who really try to want to understand this holistically and look at each city in the United States as if it were a foreign country, the way we would look at foreign countries. One last piece I wanted to add before we kind of close out and answer any questions I have is single family built to rent. This is a sector which was already happening. If you come out of the GFC, there was already a movement for single family rentals. First, it was scattered site until that inventory was sucked up. About 3-4 years ago, when that supply had been largely absorbed, there was the beginning already of communities that were purpose built for single family rentals. And that has really kind of taken off. COVID kind of just taken that trend that was already there, that product type, which is still emerging. And there's still some dispute about, is it horizontal multifamily? Is it truly single family built to rent? There's a lot of movement in this subclass, but it is really taking off. And according to the John Burns, find people who've spent a lot of time in this area, there's at least 30 billion. And I think some numbers I put together is up to $40 billion, which would be enough to finance at $250,000 a unit, something like 160,000 units to be delivered, or 40,000 a year. And so that's a meaningful amount, and we've begun to track that. And if you look at the actual population, since this slide was put together, we have over 900 locations and about 120,000 units. And you can see that the under construction piece is just beginning to ramp up, and we expect, the entire existing supply pipeline looks to be like 40,000 units, and there is a lot more that are going to be coming. And you can see it is in fact kind of southern and western, but there's a lot of midwestern stuff as well. And so this is something that's within our multifamily asset type, but can be extracted as a separate subclass. And if you look at this in terms of rent growth as well as occupancy growth, if I got this right, there we go. The rent change has been unbelievable. For several months, twice that of multifamily. In the last couple months, a few points ahead. But the demand for this product has been incredible. Occupancies, have also inclined, but mostly it's been on the rent side. And if you look at this on markets, some of these markets are just like, wow, that's incredible. And we've seen this in our data. Some of the projects have leased up very, very quickly at very, very high and accelerating rents due to the demand for the product. So it's definitely there is a need for that, and it has to occur at the fringe of the metropolitan area because of the lower density. The most dense I've seen has been like 12 to the acre, and the least is maybe 5 to 6 to the acre, and so you have to kind of have low land costs in order to make something like that kind of work. But certainly there's also a lot of variation on the occupancy changes depending upon the product. There's a couple of markets where there's not a lot of product, and it's very old, and so that kind of moves around a little bit. So there is a lot of variation, as it really is a sort of emerging asset type. And one of the things I kind of found interesting is if you look at this, right, in terms of single family rental versus a suburban multifamily rent per square foot, even on a 2.2 basis, they're not all that different. In some cases, suburban multifamily being even a little more. So what's really happening is, and this is talk about improving consumer welfare, a lot of the renters who are couples or have a pet, they're saying, well, for this roughly the same amount of money I'm paying closer to kind of the metropolitan area, I can move a little further out. I can get a little more space, and I can make that more intriguing. So the rents overall, right, while they're moving up quickly, are not far off the multifamily, suburban 2 bedrooms, 2 or 3 bedrooms. And there's not a lot of 3-bedroom product being built. The first generation of single family built to rent were more 1 and 2 bedrooms, which were really singles or couples without kids with a pet. And we're only now beginning to see a few of the actual 3 or 4 bedroom developments that are more positioned for families. But a lot of the single family rental families will go scattered site in order to get and access existing high and very good school districts. And the further out, the school districts are still emerging. And so a lot of the product is really not family oriented, but couples and pet oriented. With maybe the first child that is before school age. So I think that's an interesting wrinkle on the single family rental side. We did want to bring in here, and Jack, I'll ask you to sort of hit me up with some other questions here about what we're seeing across asset types, because there's definitely an interplay across asset types. And I'll start in self-storage. Self-storage has been a winner early on from the pandemic. And the real issue is the movement of people, whether leaving or coming, or just the dislocation has led to self-storage, incredible absorption of existing supply, which was a problem, a turnaround from declining rents to increasing rents, and just an incredible level of institutional interest in that subclass, which is a kind of a smaller subclass, but kind of crushing it. Student
What's
housing.
our expectation in
Yes.
self-storage in terms of strength of growth moving forward? And I think we should probably ask that question for each one of these sectors.
Sure. So self-storage, we're beginning to see the supply pipeline begin to move up. We're beginning to see some moderation in rent growth, and so I would expect the asset type to moderate. I mean, I don't think it could continue at the torrid pace it was. We actually created new categories to visualize the increases. In some respects, it kind of led multifamily. I do expect it to sort of moderate in its growth, but to be very profitable on a go-forward basis, and very hard for institutions to get in without actually buying out whole platforms. On student housing, there was a real question about the vitality and ability of that subclass to survive in the pandemic. Would it do as well in a pandemic that required social distancing as it did in traditional debt-based downturns? It did really well. So it did late, I think July and August. We just did a webinar on this a couple of weeks ago. It turned into a really good performance. 3% rent growth, high occupancies, back to 2019, even exceeding 2019 levels. And that, as an asset type, seems the sort of investment case has been validated. Most places did quite well. A few places, the universities struggled, as you would expect in any kind of mix. But I think that is a sector that will continue to garner investor interest as a another sort of sub-asset type. We talked about single-family built to rent. Student housing is another element of this, and we view this as a consolidation. The best universities will get better, and the fringe universities will struggle as we see a consolidation demographically driven in the student housing sector.
Okay,
Industrial,
two key points on student housing. First of which is the continuing impact of market rate not far from universities. And the second issue, is student housing in fact the answer to affordable housing in other parts of a community?
very interesting. So there are some secondary or tertiary multifamily markets where the university is not a top tier university, and the student housing project is struggling, and it's being purchased to convert to multifamily because in fact student housing is kind of like co-living, right? So the product type looks a lot similar to what co-living is. In fact, co-living was really a ripoff of student housing, and it could be a format depending upon where it's located. Okay, it could be one piece of an affordability problem for certain people, because student housing in urban areas or in tertiary markets where the multifamily market is taken off and the university is a tertiary university and not really kind of killing it. That's where student housing can provide. So it's actually providing a level of optionality underneath valuations, because there's a alternative use to the student housing asset. It can be converted to multifamily. It's really hard to convert the other way, but it's easy to convert from student housing to multifamily. So there's a lot of good stuff going on there. Industrial is just crushing it. So we've done some work there in terms of demand models and supply models, and where this and so among all the asset types, multifamily and industrial are sort of the darlings, or I'll call it residential overall, and industrial are the darlings. This capital is flowing into it. It's increasingly getting difficult to get zoned and the ability to build close enough, but there is a lot of demand for industrial, and rents are up in a meaningful way, and it's mostly a question of valuation, not overpaying for it, but as the shift to e-commerce continues, maybe not quite at the same pace as it was the pandemic, that looks really, really good. Office, like retail, is this sort of the difficult one. And I've heard it said many times, and I do agree with it, that office is the new retail. And what's meant by that is office now becomes a much more experiential product. You have to give people a reason to be there. You have to invest much more in the experience, or the work experience. See much more investments in, you have to have apps so you can, make it easy to come back. There's more investments in the physical location. Ventilation becomes much more important. So this asset type is the one where, when we look at this data and we look at the return to work, we looked at it at a building by building, tenant by tenant kind of level, is the most opportunity for both the destruction of value and the creation of value. But it is it is becoming much more operationally intensive than anyone had bargained for, probably when they went into the asset type. And so that's kind of the view there. So as we kind of wrap this up, we're seeing inflation. I expect it to continue. I expect it to accelerate to a certain extent, certainly within the 4 to 5% range. And if you recall, back in the early 70s, the 5% overall CPI index was where things tended to, where public policy fell off the rails or went off the rails. So there's a real danger in the coming years of it getting to a point where it becomes so deep in the public awareness that it becomes more embedded. So that's the danger. And will it be translated into increased interest rates and therefore a recession? I think we're a good 3 years out from that, but keep it on your radar screen. That we talked about migration and the movement of people and how that's translated into multifamily, and again, a moderation of that, but a great great opportunity. We talked about regulation. I touched on the investment risk, but I also want to be clear, very clear, right, that regulatory risk is going to be heightened in places where it already was. It's going to be escalated. And you can look at that in terms of rent regulation, eviction, in terms and conditions regulation, screening regulation, and also environmental regulation. So regulatory costs are likely to increase whether or not federal tax policy changes or not. Another kind of, I'll call it headwind, that will require dexterity on the point of players, and obviously the single family rental subclass are really kind of booming. So we covered a lot of ground in an hour. Really appreciate that. Glad you were able to join. The lawyers make you put the copyright notice and that up. I also just wanted to allude to the fact that in the slides that you will receive will be a very extensive appendix on all of the work that we've done on all the investment strategy work, investment risk work. And kind of with that, I want to turn it to Megan or to Jack for any last questions or thoughts.
Sure. Thanks, Jeff. The first question, where are multifamily cap rates going over the next 3 to 5 years?
If you looked at pure kind of interest rate risk, you would tend to say they should be moving upward, okay? Because interest rates are not going to go lower from here. However, the countervailing part of that is cap rates are much more sensitive to investment flows than anything else. And investment flows are coming heavily into multifamily. So I think if we see an increase, it will be quite muted because of the impact of capital flows. But otherwise, you would expect to see a increase in cap rates. But a lot of people have been saying that for about 5 or 7 years, and it hasn't happened because interest rates did move down, incomes did go up, and capital flows did come in. But I do think we'll see in about 18 to 24 months, the beginning of an increase in cap rates, but I think it will be moderated because of capital flows.
Jeff, you might comment in addition to that, the likely change in certainly NOI, but also the change in expenses that we've seen growing.
Well, I mean, that's when we talk about inflation risk, it's not just an interest rate risk. We had definitely seen an increase in labor cost and material costs and operating expenses, also property taxes. So there is expense pressure on NOI side, which will continue to bear itself out. They've been at the moment kind of mitigated or overwhelmed by rent increases, so on the income side. But expense pressures are definitely an issue to be grappled with. And I'm not even talking about the actual construction materials, which is another sort of thing to talk about, but just on operating expenses. Absolutely, there has been. And it's just a question of where you're located and are you getting sufficient rent increases to cover that. But if you're looking at maybe the gateway cities and the barely recovery of their rents and expense pressures, that NOI is going to be under pressure.
Great. Next question. Are there any strong multifamily markets that are in danger of softening from the build to rent supply that is coming?
Well, it's kind of hard. I mean, you're really talking about supply that's occurring at the outer fringes of a metropolitan area. I would say, all the tech hubs to a certain extent are seeing tremendous amounts of single family built to rent communities, and they will compete to a certain extent. Certainly the 2 bedrooms and smaller units will compete with suburban multifamily. However, the 3 and 4 bedrooms are just a different asset type. And I think what we'll begin to see is a much bigger shift to 3 and 4 bedrooms in the housing of families. And so largely, I see them as complementary asset types as opposed to competing asset types, because really a single family built to rent community that is 3 bedrooms and bigger is really competing with a single family home where people need the space, but they don't yet have the capital and the down pay for it. And so that's the point that I kind of see. So that I don't, you would normally pick your basic Sunbelt markets, pick any one of them. They all have a significant amount of new supply, single family built to rent coming. But I do think most of the new supply will be adjacent to in terms of unit types as opposed to directly competitive.
Sure. Given that we've seen strong GDP growth, why do you think employment is lagging?
The real issue has been these disruptions in the labor market, right? So if you look at this and you say, well, gosh, there's so many open jobs, why aren't people taking it? Well, one, there are certain folks we kind of mentioned here are looking for something better. If you look at the survey data that I saw, you'd largely say that people are reevaluating where they're living, again, at the margin, where they're living, why they're living there, why they're doing those jobs, and do they have the luxury to look for something better, right? And that's the difference of the labor force participation rate. That's the difference of actually people taking jobs versus leaving them open. There is a sorting at the bottom end of the labor market. Let's just be honest. Housekeeping work in hotels is rough work, doesn't pay well, it's tough hours. Restaurant, hotels, all the service industries, these are very difficult jobs to do. They don't pay all that well. There's disruption to them. So while wages are going up, the question is compared to what? And if you have an alternative to look for something better, why not? And if you wouldn't do it here, when would you do it? So it seems to me as if this could go on until people's financial reserves wear out, which could be until next spring or longer. I think eventually it comes back, but it could take a while, and the pricing pressures will happen. A lot of this, as we've mentioned before in many earlier webinars, we talk about technology, AI, and other sort of automation, reducing the need for lower end labor. And I think that will eventually occur. We're already seeing bits and pieces of it. But in the near term, it's just there's not enough of that to overcome the need for labor. There's also, discussions about there's just not enough technical training occurring in terms of vocational training. Everyone thinks education only means a college education and only means intellectual capital work. So there's a big void. It was being filled by immigrants. If that's not going to be a public policy response, then we need to come up with a different public policy response to train people who are not necessarily adapted to college educations. Sorry about the long answer, but I think it was a great question. Megan, anything else?
Yeah, in your investment strength analysis, you had a weighting approach where fundamentals were weighted at 25%, the same as the other categories. How strong of a view do you have that? Yeah.
Yeah, I mean, that's why I did the 40-40-10-10, because I do think that was it was overly simplistic, and I wouldn't use that. I think fundamentals are a big deal in the short term, and so to discount them so little is a bad decision. So I would think you'd be up to, you could go 50 to 60% on fundamentals and put these other factors in. And that would be my view of, as I was executing this. But we wanted to at least kind of lay out here, like, here's everything. Okay. Then you need to think about how much risk you're willing to bear, and at least being able to explain the risk that you're taking. It may be very appropriate to take a certain amount of environmental or political risk, but you should not be unaware that you're doing it. It would be the thing I would say is be cognizant of the risk you're taking, understand it, mitigate it, or work around it, or get paid for it, but don't walk into it without an understanding of it. Then I think that, in my perspective, is the biggest thing that I would want people to be aware of. And I do think the infrastructure analysis is highly relevant if you're looking at a 10-year investment and you're going into a tech hub, and you're assuming that the city can absorb the population you're expecting that's going to come. And the biggest risk is if that infrastructure is not being built out, you could have a metro area that stalls or is unable to keep up. And that's an exposure to a fundamentals, even on the fundamental side.
Sure, thank you. And then we can wrap up with this last question. Mm-hmm. As it relates to current and planned new construction, is there a risk that speculated future rent growth will not eclipse future construction labor and materials costs?
Very relevant question, because the increase in materials and labor, we really don't have a good handle on. I mean, and anyone thinks they do, I think it's kind of kidding themselves. We really don't. We're hopeful, right? But I would say this: it took about 20 years, to wring out all the efficiencies of the supply chain, and it's been scrambled. And we're seeing it kind of go in reverse. I don't know if you've noticed, but in China, they've just this morning put an all points bulletin to say, okay, we're going to dig as much coal as we can out of the ground because we're not producing enough energy to keep our economy going. So they're going back to heavily polluting coal after a flirtation with a green energy policy. Didn't work. It's not working out for them. So we're expecting some kind of reinvigoration or straightening out of the supply chain over the next year, let's say. But let's say even that does happen. Wringing out the economies out of that supply chain will take some time after they've been scrambled. And the increase in labor in China is real. Their living standards are going up. And production is being moved to other countries who themselves have had infrastructure problems and problems with COVID-19, which have disrupted the supply chain. Seeing it in coffee and other sort of raw materials. So this could take some time, and yes, there's absolutely a danger, right, of cost increases nipping the viability of projects in some outer years, and so that is probably the only prospect of whether the supply pipeline will kind of remain roughly around the 400,000 level. That's still not out of line. That can be absorbed. I don't think we're in danger of seeing 600,000-700,000 units, which would fundamentally change the demand supply balance. But we could see a potential risk to the 400,000 even if there's lack of clarity over the next 18 months as to the direction of those costs. Labor is also going to be a problem. That will kind of stretch deliveries out. I think one of the bigger concerns would be materials costs. Now, again, that's coming back. Lumber's coming back in, but it's still quite high. Steel's coming back in, but it's still quite high. There's problems there, and this stuff is, still being sorted out in the pro formas.
Great, thank you.
All right, Megan, why don't you wrap it up for us? Thank you all very much for staying.
Sure. Thank you for participating in our program today. We hope you enjoyed it and found the information and viewpoints helpful. If you would like to subscribe to any of our free research, please either log on to yardimatrix.com or contact us and we will add you to our distribution. A recording of this broadcast and accompanying slides will be available after the program. A special thanks to Jeff Adler and Jack Kern for their commentary today. I would also like to thank Jeff Muth and Mary Chu for running the web program and Claire Spadoni for her contributions to the content. This has been a production of the Matrix Division of Yardi Systems, Inc., copyright 2021, all rights reserved. This concludes our broadcast. Thank you.